The barrier has fallen. The psychological fortress that the bullion banks spent 4 decades constructing has been breached. For generations, they told us $50 silver was impossible. They told us $75 was a fever dream. They told us $100 was the fantasy of conspiracy theorists and doomsday preppers who did not understand how modern finance worked. They mocked us. They manipulated the market. They deployed every weapon in their arsenal to prevent this day from arriving. But the day arrived anyway. Silver has broken $100 in Shanghai, not in some hypothetical future scenario, not in some theoretical model. Right now, today. As I record this, the Shanghai Futures Exchange is quoting silver at the equivalent of 103.47 per ounce. The Western banking system is in full panic mode. The arbitrage that is supposed to keep global prices aligned has completely broken down, and the implications of what is happening right now will reshape the global monetary order for the next century. Welcome to Vault Zero. The $100 barrier is shattered. Let me show you why this changes everything. Before we dissect the carnage, you need to understand why the $100 level matters so much. This is not just a round number. This is not just a psychological barrier. The $100 silver price represents the mathematical point of no return for the entire paper-silver complex. Below $100, the banks could pretend. They could mark their losses as temporary. They could tell regulators that the positions would recover. They could kick the can down the road and pray for a market correction. But above $100, the pretending stops. Above $100, the losses become so large that they exceed the capital buffers of the major trading desks. Above $100, the margin calls accelerate beyond the capacity of even the Federal Reserve to suppress. The bullion banks drew a line in the sand at $100, and the market just walked right over it. They are not panicking because they lost money. They have been losing money for months. They are panicking because they have lost control. The price is no longer responding to their paper interventions. The physical market has decoupled, and Shanghai just proved it to the entire world. Let me explain what is happening in Shanghai because the Western financial media is deliberately avoiding this story. The Shanghai Futures Exchange operates independently from the COMEX in New York and the LBMA in London. It is a physical delivery market where contracts are settled in actual metal, not cash equivalents. When you buy silver on the Shanghai Exchange, you get silver. This is fundamentally different from the Western paper markets, where the vast majority of contracts are rolled forward indefinitely or settled in cash at prices that bear no relationship to physical reality. Because Shanghai demands physical settlement, the price on that exchange reflects actual supply and demand for real metal. And that price just broke $100 while the COMEX is still quoting $78. Read that again. Shanghai is trading at $103. New York is trading at $78. That is a $25 per ounce gap between the world's 2 largest silver markets. In any normal commodity market, this gap would be arbitraged away within hours. Traders would buy silver in New York at $78, ship it to Shanghai, and sell it for $103, pocketing the $25 difference minus shipping and transaction costs. This arbitrage is the mechanism that is supposed to keep global prices aligned. But the arbitrage is not happening. The gap is not closing, it is widening. And that tells you everything you need to know about the state of the Western silver market. The arbitrage has failed for one simple reason. There is no silver to arbitrage. The COMEX vaults are effectively empty of available metal. The registered category, which represents the silver actually available for delivery against futures contracts, has been drained to historic lows. The metal that remains is either spoken for by existing contract holders or is being held in the eligible category by owners who have no intention of selling at current prices. When a Chinese industrial buyer looks at the COMEX and says, "I want to buy 10 million ounces and ship it to Shanghai," the answer is, "We don't have it." When a Swiss refiner tries to source metal to meet Asian demand, the answer is, there is a 6-week wait. When a sovereign wealth fund attempts to take delivery on a futures contract, they are offered a cash premium to settle instead because the exchange cannot deliver the physical metal. The arbitrage requires physical metal to function. Without physical metal, the arbitrage dies. And when the arbitrage dies, the prices diverge. Shanghai is telling you the real price of silver. New York is telling you the price of a paper promise that cannot be kept. The $25 gap is the measure of how broken the Western system has become. Now let us talk about why the banksters are panicking. I use that term deliberately, banksters, because what we are witnessing is not the failure of legitimate market making. It is the collapse of a criminal enterprise that has operated for decades under the protection of regulatory capture and monetary authority complicity. The major bullion banks, the names, the institutions that are supposedly the pillars of the global financial system, they have been running a fractional reserve scam in the silver market for 40 years. They sold paper silver, contracts representing metal that did not exist, to suppress the price below its natural equilibrium. They collected fees and commissions on these phantom sales. They earned the spread between the artificial low price and what the price should have been. And they assumed, with the arrogance that only comes from decades of impunity, that they would never have to deliver. The Shanghai price at $103 is the moment of delivery. The physical market is calling the bluff. The paper promises are being presented for redemption, and the vault is empty. Let me quantify the panic for you because numbers speak louder than adjectives. Based on the latest Commitment of Traders report and the Bank Participation report from the CFTC, the 8 largest banks hold a combined net short position of approximately 80,000 contracts in COMEX silver futures. Each contract represents 5,000 ounces. That means these 8 banks are short 400 million ounces of silver. 400 million ounces that they sold and do not have. At the Shanghai price of $103 per ounce, the replacement cost for this position is $41.2 billion. At their average entry price of approximately $28 per ounce based on historical analysis, their original liability was $11.2 billion. The difference, $30 billion, is their current loss. $30 billion evaporated from bank balance sheets because the price of silver in Shanghai broke $100. And the COMEX price has not even caught up yet. When New York reprices to match Shanghai, which it must eventually do because you cannot have 2 prices for the same commodity forever, the losses will expand further. If COMEX reaches $100, the per ounce loss expands from $75 to $70 times 400 million ounces. Wait, let me recalculate that correctly. At $100 COMEX versus $28 entry, that is $72 per ounce times 400 million ounces equals $28.8 billion in losses. But at $103 Shanghai, the losses are $75 per ounce times 400 million ounces equals $30 billion, as I stated. And we are just getting started. Every additional dollar that silver rises adds another 400 million in losses. At 110, the losses hit $32.8 billion. At 120, the losses hit $36.8 billion. At 150, which is now a realistic 12-month target given the supply dynamics, the losses hit $48.8 billion. This is extinction-level mathematics for the trading desks involved. The panic is visible if you know where to look. First, examine the lease rates. The silver lease rate is the cost that banks pay to borrow physical silver from central banks or large holders. In a normal market, this rate hovers around 0.5% to 1% annually. It is a low cost because silver is supposedly abundant and easily borrowed. But the lease rate has spiked to over 10% in the past week. 10% annual cost to borrow silver. This tells you that the metal is not abundant. It tells you that the banks who need to borrow silver to meet delivery obligations are bidding aggressively against each other for the limited supply. A 10% lease rate is a scream of desperation. It is the sound of banks willing to pay any price to get their hands on metal they should have had all along, but never actually acquired because they were running a naked short scheme. Second, examine the backwardation structure. In a healthy futures market, contracts for future delivery trade at a premium to spot prices. This is called contango, and it reflects the cost of storage and financing. But silver is now in steep backwardation across the entire curve. The front month contract is trading higher than the back months. This is inverted. This is unnatural. This only happens when the market is screaming for immediate physical delivery because participants do not trust that the metal will be available in the future. Backwardation is the futures market admitting that the paper promises are worthless. It is the market saying, "I want the silver now," not a contract for silver in 3 months that you might not be able to deliver. The backwardation in silver is now deeper than at any point in modern market history. It is deeper than during the Hunt Brothers squeeze in 1980. It is deeper than during the 2011 run to $50. The market is more broken today than it has ever been, and Shanghai at $103 is the proof. Third, examine the premium structure in the retail market. This is where the dysfunction becomes visible to ordinary people. The paper price on COMEX might say $78, but try to actually buy an ounce of silver for $78. Go ahead, I will wait. You cannot do it. American Silver Eagles are selling for $55 over spot when you can find them at all. Generic rounds are $20 over spot. 100-ounce bars, which historically traded at tiny premiums, are now $15 to $20 over spot with 4-week delivery times. In some cases, the premiums have reached 100% over the paper price. 100%. That means the actual cost to acquire physical silver is double what the COMEX screen says. This is not a functioning market. This is a two-tier system where the paper price is a fiction and the physical price is reality. Shanghai is trading at the physical price. New York is trading at the paper fiction, and the gap is $25 per ounce and growing. The Western banks are trying everything to close this gap from their side rather than letting their paper price rise to meet reality. They are employing the same tactics that have worked for 40 years, hoping that muscle memory will save them. They are dumping massive volumes of paper contracts during the thin trading hours of the overnight session, trying to trigger stop-loss selling and create the illusion of weakness. Last night, someone sold 15,000 contracts in a 3-minute window at 2 a.m. Eastern Time. 15,000 contracts represents 75 million ounces of silver, nearly a month of global mining production, sold in 180 seconds when nobody was watching. This is not a legitimate hedge. This is not a rational market participant. This is a desperate intervention by an entity with unlimited paper ammunition trying to defend an indefensible position. And it failed. The price dipped briefly, then recovered within an hour. The Asian buyers absorbed the selling and kept bidding. The Shanghai premium remained. The gap did not close. The attack was repelled. For the first time in 4 decades, the unlimited paper ammunition is not working. The physical market is stronger than the paper manipulation. The weapon has become useless. Now let us discuss why Shanghai specifically matters to the power dynamics of the global monetary system. This is not just a story about silver prices. This is a story about the transfer of financial power from west to east. For 75 years, the United States and its allied banking institutions have controlled the pricing of global commodities. Oil is priced in dollars. Gold is priced in London and New York. Silver is priced on COMEX. This pricing power gave America an extraordinary privilege. It allowed the U.S. to pay for real goods with printed paper. It allowed the U.S. to run permanent trade deficits without consequence. It allowed the U.S. to sanction any nation by cutting them off from the dollar payment system. This privilege was built on control of commodity pricing, and that control is now slipping away. Shanghai at $103 is China saying, "We reject your paper price." Shanghai at $103 is China saying the real price of silver is determined by physical supply and demand, not by banks selling contracts they cannot deliver. Shanghai at $103 is China saying, "We have the metal, we have the industrial demand, and we will set the price." The geopolitical implications are staggering. China has been accumulating silver strategically for over a decade. They import hundreds of millions of ounces annually through Hong Kong and Shanghai. They refine it domestically. And they never export it. The metal goes in but does not come out. Conservative estimates suggest China has accumulated between 500 million and 800 million ounces of silver over the past 10 years. This silver is held by state-owned enterprises, the People's Bank of China, and strategic reserve facilities that do not report to Western statistical agencies. China looked at the Western paper market, understood that it was a fractional reserve fraud, and decided to accumulate the real asset while the price was artificially suppressed. They let the West sell them silver at $20, at $25, at $30. They took delivery every time. And now, with the vaults empty and the price breaking $100 in their market, they hold the winning hand. The West holds paper claims. China holds 800 million ounces of physical metal. When the paper market fails, and it is failing right now, the physical holders win. China wins. The Western banking system loses. This is the wealth transfer that is happening in real time. Shanghai at $103 is not just a price, it is a declaration of victory. The industrial dimension makes this even more critical. Silver is not just a monetary metal, it is the most electrically conductive element on Earth. It is essential to solar panels, electric vehicles, 5G infrastructure, medical devices, and military applications. Every smartphone contains silver. Every electric vehicle contains silver. Every solar panel contains silver. And global demand for these products is exploding while silver mine supply is flat or declining. The solar industry alone consumed 140 million ounces of silver last year, up from 50 million ounces a decade ago. Electric vehicle production is consuming silver at a rate that will reach 100 million ounces annually within 5 years. And the military applications, from missiles to radar systems to satellite components, consume tens of millions of additional ounces that never appear in public statistics. The industrial consumers do not care about the paper price. They need the physical metal to manufacture their products. When the solar panel factory in Shenzhen needs silver, they pay the Shanghai price. When the battery factory in Hefei needs silver, they pay the Shanghai price. The industrial economy operates on physical reality, not paper fiction. And physical reality says silver is worth $103 per ounce because that is what the industrial buyers are willing to pay to secure supply. Let me tell you what this means for the COMEX and the Western banking system. The gap between Shanghai and New York creates an impossible situation for the bullion banks. They are short 400 million ounces on COMEX at a price of $78. The same metal is trading for $103 in Shanghai. If they try to cover their shorts by buying on COMEX, they drive the price up toward Shanghai levels and crystallize billions in losses. If they try to source metal from the physical market to meet delivery obligations, they have to pay Shanghai prices plus shipping, which means they are delivering metal that cost them $103, but they sold for $30. If they do nothing, the delivery failures mount, the exchange declares force majeure, and the entire paper market loses credibility permanently. Every option leads to catastrophic losses. There is no exit. There is no clever financial engineering that makes this problem disappear. The only variable is whether the losses are taken quickly in a violent repricing event or slowly through a grinding delivery crisis. Either way, the banks are facing hundreds of billions in total exposure when you include the OTC derivatives layered on top of the exchange-traded positions. The Federal Reserve is aware of this situation, the Treasury Department is aware, the regulators are aware, and they are terrified, not because they care about the banks per se, but because they understand the contagion risk. The bullion banks are not standalone entities. They are the same institutions that make markets in treasury bonds, that provide liquidity in the repo market, that underwrite corporate debt, and that hold the savings deposits of millions of Americans. If JP Morgan loses $15 billion on silver shorts, that loss does not exist in isolation. It impairs their capital ratios. It triggers concerns from counterparties. It raises questions about what other hidden losses might be lurking on their books. The failure of one major bank's commodity desk could cascade into a broader financial crisis through the daisy chain of counterparty relationships. This is why the Fed is quietly providing unlimited liquidity through the repo facility. This is why the Treasury is not commenting on the silver situation. They are hoping to manage the crisis in the shadows, to spread the losses over time, to bail out the banks without the public noticing. But the Shanghai price at $103 makes that impossible. The price is too visible. The gap is too large. The divergence is too obvious. The market is forcing a resolution. Now I need to address the propaganda that the mainstream financial media is deploying to explain away what is happening. They are not reporting on Shanghai $103. They are not discussing the $25 arbitrage gap. They are not explaining why the lease rates have spiked or why the delivery failures are mounting. Instead, they are running stories about how silver is overbought, how the rally is exhausted, how smart investors should take profits. This is coordinated narrative management. The same banks that are short silver own the media companies that report on silver. The same analysts who recommend selling silver work for institutions that profit if you sell. Do not let them gaslight you. Do not let them convince you that the Shanghai price is somehow fake or irrelevant. The Shanghai price is the only real price. It is the price that industrial buyers pay for physical metal. It is the price that reflects actual supply and demand. The COMEX price is the fiction. The COMEX price is the paper promise, and paper promises are burning in Shanghai. Let us talk about the roadmap from here because this is where the analysis must become actionable. The Shanghai breakout above $100 is not the end. It is the beginning of a new phase. Phase 1 was accumulation, the years when smart money quietly stacked physical metal while the paper price was suppressed. Phase 2 was awakening, the period when the premiums started to rise and the retail community began to understand the manipulation. Phase 3 is divergence, what we are witnessing now, when the physical market prices decouple from the paper market. Phase 4, which is coming within weeks or months, is convergence, when the paper price is forced to rise to meet physical reality because the arbitrage finally closes. During convergence, the COMEX price will not rise gradually. It will gap. It will jump $10 or $20 in a single session as the shorts are forced to cover and the paper market capitulates to physical truth. The move from $78 to $100 on COMEX could happen in a single week. The move from $100 to $120 could happen in days. This is what a market looks like when 4 decades of suppression unwinds in real time. What should you do with this information? First, if you do not own physical silver, acquire it immediately. Not paper silver, not ETF shares, not futures contracts. Physical metal in your possession or in allocated storage that you control. The premiums are high, yes, but the premiums reflect reality. Paying $95 for an ounce of silver when Shanghai is trading at $103 is not overpaying. It is getting a discount to the true world price. The premium is not a cost. It is an acknowledgement that the paper price is fake. Pay the premium, get the metal, remove it from the banking system. Second, if you own paper silver through ETFs like SLV or SIVR, understand the risks. These funds are supposed to hold physical metal to back the shares, but the authorized participants who manage the funds are the same banks who are short silver. They have the ability to create shares, to redeem shares, and to shuffle metal between their trading desks and the fund vaults. When the delivery crisis intensifies, the ETFs will be rated to source metal for COMEX delivery. The shareholders will be left holding claims on vaults that have been emptied. The tracking error between the ETF price and the physical price will explode. If you insist on holding paper silver, at least diversify across multiple vehicles and be prepared to exit quickly when the system shows signs of stress. Third, watch the lease rates and the backwardation curve. These are the vital signs of the physical market. If the lease rates keep rising, it means the squeeze is intensifying. If the backwardation deepens, it means the delivery crisis is accelerating. These indicators will give you early warning of the Phase 4 convergence event before it shows up in the spot price. The spot price is the lagging indicator. The physical market signals are the leading indicators. Follow the leaders. Fourth, prepare for volatility and do not panic during the manufactured sell-offs. The banks will continue to dump paper contracts during overnight sessions. They will try to create the appearance of weakness. They will plant stories in the financial media about silver being overextended. These are the death throes of a dying manipulation scheme. Each attack will be weaker than the last. Each recovery will be faster. Eventually, the attacks will stop entirely because the banks will run out of margin capacity to sustain their short positions. Until then, treat every dip as a gift. Every $5 pullback is another opportunity to accumulate physical metal before the convergence event. Fifth, understand that this is bigger than silver. Silver at $103 in Shanghai is a symptom of a global monetary system that is breaking down. The dollar hegemony that has defined global finance since 1944 is ending. The BRICS nations are building alternative payment systems. Central banks are accumulating gold at the fastest pace in history. The weaponization of the SWIFT system has proven to the world that dollar assets are not safe from political seizure. Silver is rising because the dollar is falling. Gold is rising because confidence in fiat currency is collapsing. Commodities are rising because real assets are being repriced against paper promises that are losing credibility. Position yourself for this transition. Own things, not claims on things. Own metal, not paper. Own land, not REITs. Own productive assets, not financial derivatives. The next decade will reward those who hold real assets and punish those who trusted the paper system. The $100 barrier is broken. Shanghai has spoken. The price that the Western banks told you was impossible is now trading on the largest physical delivery exchange in the world. The gap between East and West is $25 per ounce and widening. The arbitrage that is supposed to close this gap is impossible because there is no metal to move. The banks are facing $30 billion in current losses that will grow to $50 billion, $70 billion, $100 billion as the price continues to rise. The Federal Reserve is printing money to keep them alive, but the printing is accelerating the very inflation that is driving silver higher. It is a doom loop with no exit. The more they print, the higher silver goes. The higher silver goes, the more they must print. And through it all, Shanghai keeps printing a price on the screen that tells the truth. $103 per ounce. That is the real price. That is the physical price. That is the price that will eventually appear on every screen in the world when the paper fiction finally dies. We are witnessing the end of an era, the era of unlimited paper suppression, the era of fake prices and empty vaults, the era of Western banking dominance over commodity markets. It is ending not with a whimper, but with a bang. The bang of Shanghai 103, the bang of lease rates at 10%, the bang of backwardation deeper than 1980, the bang of premiums at 100% over spot, the bang of delivery failures and force majeure warnings. Every signal is flashing red, every indicator is screaming that the system is breaking, and when it breaks, those who hold the metal will be on the right side of history. Those who hold the paper will learn the hard way that a promise is only as good as the promiser. And the promisers, the bullion banks, the Federal Reserve, the entire Western financial establishment, they are bankrupt. They just have not admitted it yet. Shanghai at $103 is the first admission. The rest will follow. I am Vault Zero. This is the breakdown. Silver has broken $100 in Shanghai. The banksters are panicking. The arbitrage is dead. The physical market has won. And if you own the metal, you have won too. Do not let them shake you out. Do not let the volatility scare you. Do not let the propaganda confuse you. The price you see in Shanghai is the price that matters. And that price is going much higher from here. The $100 barrier was just the first wall. There are no more walls after this. There is only blue sky and the repricing of a monetary metal that has been suppressed for 4 decades. The suppression is over, the repricing has begun, and you are positioned to benefit from the greatest wealth transfer in modern history. Like and subscribe if you want to keep seeing the truth. Share this video with someone who still believes the paper price. And I will see you in the next report, where we will track the convergence and show you exactly how high this market can go when the paper finally dies. The vault is open, the truth is out, and silver is free. See you next time.